stay up here unless, Marielle, there's something else we want to get into? Okay. If it works with them off, if that's okay for you guys, probably nasty weather, but I think that's good for this with the skylight here. That's good. Okay, so like I said, most of you are familiar. We either work with you or we've done these courses with you guys in the past, and we appreciate you guys coming out. What might ring a bell is my teaching a CE class called Navigating a Challenging Market, basically for the past 3 years. So in a 3-year time span, I probably taught that CE course 25 or 30 times to different groups, online and in person. And we put a lot of thought and energy into that course when the insurance market started getting difficult, right? Because the idea was these premiums are getting out of control. How can we get as much information out there as possible? So we basically ran with that for 3 years. And the day that we made that class, right, and the first day that I taught that class was the first day that I started looking forward to teaching this class. This is kind of light at the end of the tunnel, right? We just went through a very, very challenging insurance market. The market is starting to shift. The market is starting to get more healthy, more competition. So knowing that, right, what's going to be different for you as board members, as managers, in navigating a healthy market as opposed to navigating a difficult market? It's very different in terms of preparation, in terms of strategy. So that's kind of going to be the goal today as far as information and what can we accomplish together. A little bit about me. I specialize in working with condominium and homeowners associations. I graduated from Florida State with a degree in risk management and insurance. I went to school for it. I grew up in it, as exciting as that sounds. 3rd generation insurance, so my mother was in it, my grandmother was in it. We have our own potential 4th generation. She turns 2 on Saturday, so it's a little early, but we're getting there with her. I was born and raised in Palm Beach County, so I know the area well. We've been through numerous storms and we've seen the market shift numerous times in that span. So what we're going to kind of talk through today, right? The way that I kind of broke this course up is how did we get here, right? Because I think that's a really important part of our conversation. I think for the past 3 years, everyone knew that insurance premiums were going up, but I feel pretty strongly that there was not a ton of transparency in our world as far as why that's actually happening. And I think that's really important because you have to identify why something is going wrong in order to fix it, right? So that's going to kind of be the first portion. We're going to talk about market trends. So what's actually happening? What are we seeing as far as pricing, renewal terms? What should everyone kind of expect going into your renewal? We're going to talk about citizens, which is always a tricky conversation, but a lot of changes there as well as the market shifts. And then we're going to talk about renewal expectations and how can you best prepare your community to go into the renewal knowing it's going to be a lot more positive than the past 3 years and come out with the best available. So what I think is really important for everyone to understand about insurance generally, right? So this is not even condo, HOA, co-ops. This is insurance across the board. One of the fundamental trends and principles that we see with insurance is that it is cyclical. It always has been hundreds of years. If you look back at the premium for your association over a 20 or 30 year time span, you would probably see periods of years where premiums were going up and years where premiums were going down. Now, full disclosure, not proportionally. I don't think we've ever seen anything like we just saw the past 3 years. The past 3 years is literally the most difficult stretch in the Florida insurance market ever, okay? So we are starting to see the light at the end of the tunnel with that, but there's a number of drivers to that, right? It wasn't just happening out of nowhere. There were certain drivers shifting the market where we were seeing premium increases and inferior terms. And there's really 3 legs to that. I kind of think of it as 3 pillars to why the insurance market was challenging. The first is kind of the most obvious, I think of, when we think of why might insurance premiums be going up? Losses, right? We have seen a dramatic increase, not only in the severity, so how big some of these losses have gotten, but the frequency. And frankly, the frequency is a more challenging issue for a lot of companies than the severity. To put that into perspective, right, this graphic is from the NOAA, and each of these little dots on this map are separate $1 billion loss events, okay? So obviously we think of hurricanes, but insurance is general, and it's global, right? So it could be wildfires, tornadoes, flooding, hurricanes. Each of these dots is a separate $1 billion event. For perspective, okay, if you look at the number of individual $1 billion losses on a per year basis, going back to 1980, the average is 8.5 per year. So 8.5 $1 billion events per year is the historical average. The past 5 years, that's grown to 20.4 per year. That's the 5-year average. So the trend, right, is no longer on average are we looking at 8.5 separate $1 billion events, it's 20. It's a 2.5 times increase in the number of significant loss events. So this has become very challenging for insurance companies. They're getting a grasp on it, and there's been a lot done about it in the past 24 months, but we're still seeing them frequently. I mean, Aventura, we had those tornadoes here. Obviously, the most recent, California, with these wildfires, those fires, I mean, obviously it's been in headlines and everyone understands how devastating and how catastrophic, but I mean, even until a couple weeks ago, I didn't realize that's literally going to be the most expensive fire of all time. So the economic losses, and the data is early, they're still quantifying, but it's somewhere around $50 billion covered, so insured losses, and around $250 billion economic. So these are huge numbers. All right, so that's kind of the first piece of this puzzle as far as what's caused premiums to go up for the past 3 years. We have seen a significant increase in not only the severity, so how high the number gets, but also the frequency and how often we're seeing these significant losses. Inflation is kind of the second piece of this, right? And this one we see often. This is not just an insurance thing, this is a grocery store thing. We've seen the cost of almost everything increase over the past 3 years. If you've updated your appraisal, which most of us are, safe bet no one's values have gone down in the past 4 years, I would guess. So the cost of construction is also rising, which is causing insurance premiums to go up because you're now buying more insurance. So that's the second piece of it. Losses, inflation, and then litigation is the third piece of this. And Florida, we're very special, some good ways, some bad ways. I don't think I'm gonna surprise anyone when I say that Florida, we have a pretty serious problem with litigation and fraud and frivolous claims, okay? You don't have to drive very far down the highway to see the billboards, and it's everywhere. So, and the challenge with this is that there's a very, very small handful of firms that have figured out how to exploit this perfectly. The Florida insurance legal environment. It's very specific. For perspective, just to kind of illustrate, right, how significant the problem is for Florida, our insurance commissioner, every year since 2019, in his State of the Market, his annual kind of State of the Union report, he's referenced a statistic in there that's amazing. And the statistic reads that Florida buys about 8% of the property insurance in the country, okay? 8%. But about 76% of all of the property insurance litigation in the United States has been concentrated to Florida over the past 5 to 10 years. So it's amazingly disproportionate. 3/4 of the country's property insurance litigation has been concentrated to one state. That, to me, that is what has been even more challenging for insurance companies to navigate, even more so than the losses. So, and I know I said this was going to be positive, somewhat positive, of course, and it will be. So, but this context is important because we have to know how we got here and what's being done about it. And there is something being done about it. Okay, so our legislators in 2023 did pass a number of bills that target Florida's kind of underlying legal environment that's made it so challenging for insurance companies to navigate. One of the things that they've eliminated in these bills, in this new legislation, is one-way attorney's fees. Now, the way that this works is Florida statutes have been written historically, right, such that if a policyholder sues the insurance company is prohibited per Florida statute from going after legal expenses, no matter how that shakes out, what happens, okay? Now, obviously, the intent of that is consumer protection. The intent is good. The intent is, okay, we have individual policyholder, massive billion-dollar insurance corporation, right? If there's a legal dispute over a claim, how can we level the playing field? And the concept was, well, let's prohibit the insurance companies from pursuing legal expenses throughout that process. The problem is that, like anything, there's a handful of legal firms that figured out how to exploit that very effectively, right? Because the idea to the policyholder for the unscrupulous attorneys and the unscrupulous public adjusters was, look, sign up here, let's sue your insurance company, and let's see what happens. There's no downside, right? Because they can't come after the legal expenses, and I'll work on contingency or whatever it is. So it was a very no downside approach, and obviously, and I should have prefaced this part of the conversation with, there's good and bad attorneys, there's good and bad public adjusters, there's good and bad insurance agents, right? It's a small number of these firms that have really taken advantage of this. In addition to the one-way attorney's fees being eliminated, by the way, those are no longer, okay? Assignment of benefits has also been a huge problem in our world for a number of years. So assignment of benefits letters is an intent letter with an adjuster or an attorney where you as the policyholder give them access to the policy, okay? And you give them full rights to the policy, rights to settle claims, rights to negotiate with the insurance company, everything. So that assignment of benefits letter as an engagement letter is very specific, and frankly, for years, there hasn't been a lot of transparency as to what that actually does, okay? The assignment of benefits letter, which by the way has also been eliminated, this is no longer permitted in the state, but what was happening is the policyholder was being presented with this letter in kind of a sign here, we'll go to bat for you, we'll help you with your claim type fashion. But the piece that wasn't necessarily always being communicated was the fact that once you sign this letter, the agent is completely removed from that conversation. The agent is no longer able to communicate with the carrier, negotiate on your behalf, help you through the claim. And the challenge is that following major storms, these letters were being signed in the thousands, tens of thousands at a time, okay? So what was happening is all of this kind of worked together. It was kind of a perfect environment for a sign here, right? Give us access to your policy. There's no downside, right? Because if we sue your insurance company, they can't come after legal expenses. It was a very prime environment for unscrupulous behavior, all right? So again, this has been eliminated, which is positive, and we're seeing now a lot of shift because of this. We're starting to see premium shift, we're starting to see more competition in the market, and one of the questions that I get asked a ton, and it's a legitimate question, is, Andrew, you just said this legislation got passed January 1st of 2023. We're January, mid-end of January 2025. Why did this take so long, right? We've still been seeing premium increases since January 1st of 2023. And there's a really interesting piece of this as far as timing goes. So basically the way this played out, right, when our legislators finally realized, okay, this is not sustainable. The insurance market is catastrophic right now. About 18 months, 2 years late is when everyone started reacting, but albeit still finally reacting. So this is how it played out. In May of 2022, our legislators met for a special session, talked this through, didn't do anything about it, okay? Not overly surprising. September of 2023, Hurricane Ian hit the West Coast, okay? Catastrophic claim. This was, I think the most recent number was 55 billion. Hurricane Ian, 55 billion with a B, okay? For perspective, second costliest storm ever to hit the United States behind Katrina, costliest to ever hit Florida. All right, so the insurance market was already in a problematic state. Hurricane Ian hits in September before any legislation is passed. That happens. Legislators meet again in December of that year, okay? So after Hurricane Ian, and pass this legislation. The challenge with that is the legislation was not retroactive. So it applied to any claim after January 1st of 2023. How many Hurricane Ian claims were filed in the interim? And by the way, obviously a ton of them legitimate, a ton of them catastrophic storm, but a lot of them also not so much. There's a very important difference between that. But in that time span, from Hurricane Ian to 1/1 of 2023, there was 708,255 claims filed. All of those not subject to the change in litigation, change in legislation. So the problem as far as timing goes and why we're not having this conversation earlier, because trust me, I was ready to start teaching this CE course 12 months ago, but the reason this drug out is because there was this huge wave of claims that was subject to the old rules that kind of had to play out before we started to see these new trends take place and started to see the litigation figures come down. So I know that's a lot of background, and here's where we start the positive part of our breakfast. It's working. It's absolutely working. Okay? We're starting to see significant decreases in insurance companies' cost to settle and litigate claims. A lot of these ratios, this is the DCCE ratio. This basically shows, on average, an insurance company's cost per claim as far as litigation goes, and it's come down 63% in 12 months. Yeah, it's big drops. We've also seen a 23% decrease in the total volume of filings, of suits filed, 2024. So these are big changes, right? This is not 1 or 2% decreases. These are significant numbers. And what does that mean, right? What does that mean for everyone in this room? It's been a lot of citizens renewals. It's been a lot of, here's citizens, here's your one other option renewals, right? Everyone's experienced that for the most part, and it's been very, very difficult. The past 12 months, we've had 8 or 9 insurance companies come into the state targeting condominium and homeowners associations. Now, we've had more than 8 or 9 come in generally, but most of them are targeting homeowners insurance, individual homes. This is different. This is actually insurance companies with the financial stability and the appetite to write condominium, homeowner association, hurricane exposed property schedules. This is significant. We haven't seen this in 4 years. I mean, it's been constant. Companies leaving the market, deemed insolvent, one option at renewal, and it's been very, very challenging. So with this being said, these kind of broad conversations are always a little bit tricky because we're definitely having a positive conversation, but your renewal this year will absolutely be more positive depending on the characteristics of your association. So what I mean by that is when we're in an environment like we are now, where most or a lot of associations are with citizens, premiums have gotten incredibly high. When these companies come into the market for the first time or come back, they're in a really unique position. They're in a position to kind of pick and choose which associations they want to put on the books, right? Because the market's been so uncompetitive. So what happens when we see a shift like this is the first communities that are going to start to see significant premium decreases are newer roofs, maybe inland communities. We're definitely seeing more options on the garden style communities relative to the high-rise or coastal high-rise buildings. That being said, and I know this is hard to see, but what I want everyone to see is the length of this renewal comparison horizontally, right? Now, full disclosure, I'm definitely not saying that every community is going to have 7 options at renewal this year, right? But I am also saying this is a real renewal. We just did this renewal a few months ago with a garden style, inland, newer construction. I think this was 2017 construction. So, pretty unique characteristics. But last year, Citizens was the only option. This year, we literally had 7 options from different companies, different deductible options. So it's a much different conversation this year as far as carrier availability, competition, how many options are we gonna have? It's so much healthier, right? So that's a very positive thing. And what this is very relevant as well for citizens communities. And I say that citizens is absolutely the market of last resort. It always has been. Out of curiosity, how many of your communities are either with citizens or were with citizens the past 3 years? It's almost everyone, right? So, and that's normal. In a difficult market, citizens is designed to expand, and in a challenging market, they're designed to shrink by nature. That's how they work, and you see that in the numbers. If you look at 2019, Citizens was down to 420,000 policies in place in Florida. Citizens peaked in September of 2023 at 1.4 million. So, market of last resort, 400,000 policies, growth to 1.4 million. Dramatic increase, okay? So, I emphasize that because right now, there's a lot of opportunity to potentially get out of citizens if you're with citizens. And again, case by case basis, it's going to depend on each individual association's characteristics and a lot of variables. But to emphasize how aggressively this is happening, citizens is actually depopulating their own policyholders. So they, as the market of last resort, Citizens has this mechanism in place where they call it a clearinghouse. That's the phrase they use. It's basically a back door into Citizens where they open their books for private insurance companies. They don't give them the premiums, but they give them a whole file to underwrite every association. And they quote it, and if the private company provides a quote for your association and you're with Citizens, if that quote is comparable terms, which it will be, because again, Citizens is designed to have bare bones as far as coverage, and if the pricing is the same or up to 20% more, you automatically get moved into the private market. So even if the alternative option is 19% higher, if it's not 20% higher, you'll still get moved. This is something to pay attention to, because in this market, this is happening a lot, but you're only required to move if it's within 20%. I emphasize that because if everyone kind of just keeps that in the back of their mind, Citizens will automatically move you if you don't respond to the letter. So if you get a quote from a private company through this back door and it's 75% higher, if you don't respond and say, no, we'd like to stay with Citizens, they'll move you. So anything in the mail from Citizens next 12 months, I know, trust me, it looks like throw it away immediately, but just open it. Because if it's a takeout letter, you want to make sure that it makes sense to move. So, Citizens, I know we kind of just talked about the growth and the depopulation of Citizens in a soft market, right? We call the challenging market, hard market is the phrase in the insurance world. Soft market means it's getting better, healthier, competitive, okay? In the soft market, what Citizens does, and it's incredibly frustrating, which is not going to surprise anyone, and obviously a lot of us have worked with Citizens, not super easy to work with. In a soft market, what they do is they get much more strict with their underwriting, with their renewals. They become very, very difficult to work with, okay? Things like requiring updated appraisals. Just so everyone knows, with Citizens, if you're not with Citizens already and you're looking to go to Citizens, you have to have an appraisal that's no more than 12 months old. This is new. Doesn't matter if you're a condo, doesn't matter if you're an HOA, doesn't matter. Even though the statute only requires every 3 years for condos, Citizens threw it out and said we now want 12 months. So it's an additional requirement that we didn't have prior. Citizens is also getting very, very strict on the milestone inspections. When you've had those done, they want everything. They want the inspection, they want to see everything that you've done as far as resolving any issues, paid invoices, permits. They do not mess around anymore with requiring documentation. Roofs is also where Citizens has become unbelievably challenging and frustrating. And I say that genuinely because I know this is probably going to sound a little funny coming from the insurance guy, but some of the roof requirements are very difficult to accept because Citizens has these arbitrary across the board guidelines where they, depending on your type of roof, so for instance, flat roof is 15 years, they require a replacement within 15 years. Now there's always been this kind of carve out and kind of this exception where you could get a roof certification done, which is basically an opinion by a licensed roofer or a GC that says the roof has remaining useful life, and they've taken that. But as the market has gotten healthier, and as private options have become more available, they've really tightened up on it. They do it intentionally, because you have to understand, Citizens in a perfect world would have 0 policies. They do not want to do your coverage. That's why it's so difficult to work with them, because the business model is completely backwards, okay? So they're getting very, very strict with this. If you're replacing their roof, your roof or your roofs, they're requiring a lot of documentation, signed contracts, proof of down payment, permits, just to offer a renewal. I mean, I know Donna, you and I were talking about this earlier, but it's very frustrating because it's gotten, they've added all of these additional hurdles as if they weren't already the most difficult company to work with. So it's intentional. This is a ridiculous example of the inefficiency that I'm talking about, and this is more of a just a funny anecdotal situation, but Citizens out of nowhere, this is like 6 months ago, came out, they sent a bulletin out to all of their agents and said, we will literally no longer accept at all any photos of any roof taken with a drone. With a drone. So, and this happened on one of our associations, and my call with Citizens, and this is like, I mean, I'm paraphrasing, but this is actually how the calls go. It's painful. The conversation was, okay, I hear what you're saying. I know that you guys are requiring this, but hear me out. If I have an inspector, right, go on the roof that's about 6 foot tall, that's the angle you're gonna get of the roof, right? So, what if I get the inspector to agree to fly the drone exactly 6 feet up, exact same angle? You will get literally the same picture that you would get if it was an inspector on the roof. And the response from the underwriter was, if there's not a shadow of a person in the picture, we can't accept it. It's literally nonsense. Like, you know, it's so difficult, because to me this is like the equivalent. These drones, it makes it so much faster. It makes it so much easier for these guys to do the inspections. This is the equivalent of me one day saying, okay, everything's going great, but for the time being and going forward, I'm gonna do my job without a cell phone. I mean, I could, but it's horribly inefficient, and it doesn't help anyone. So these are the types of things that we're dealing with citizens in a soft market or a transitioning market. I emphasize this because I encourage everyone to start having these conversations early to get ahead of this kind of stuff, because hopefully a lot of your communities are going to be in a position where you're moving from citizens this year, but if it's older roofs, if it's older coastal high-rise, you may still be with citizens, and you're going to want to start these conversations early to start tackling extra inefficiencies that you didn't have to last year. I know how obnoxious that sounds, but I'd much rather be the one standing up here and telling you citizens is going to be even worse to work with, unfortunately, than you not knowing and, you know, scrambling last minute or doing things late that you could have otherwise accomplished. So, for the communities that either are moving away from citizens this year, which, again, I feel strongly it's going to be a lot of them. By the way, Citizens is under 1 million policies in Florida for the first time since 2022. Yeah. So it is shifting. A lot of our communities have started to find homes outside of Citizens. And even if you're not with Citizens currently, your insurance company has probably changed terms for the worse in the past 3 years, right? No one's deductibles have been getting better. None of the insurance companies have been offering extra coverage as the market has been challenging. So whether you're going to be moving from Citizens or renewing in the private market where you already are, there's a lot of things that I think are going to change. Pricing obviously is the big one, right? All of us have been waiting for the day that the premiums stop going up 20, 30, 40, 50, 60% year over year, unsustainable, and that is happening. We're starting to see, and again, it's a broad conversation, so grain of salt, but decreases in most cases, right? And in some cases, significant decreases when there's multiple options in different companies. But in addition to that, what everyone should be looking out for is we're gonna start getting coverage back. That's been the other thing that's happened in the past 3 years, and it's kind of flown under the radar because the focus rightfully has been the premium, but companies have also changed the way your coverage works in a lot of situations. One of these has to do with your roof, and a lot of companies in the past 3 years have changed the way they value roofs, or the way that they would pay a claim for your roof. When you do an insurance policy, right, when an insurance company agrees to insure you, there's 2 ways they can pay claims. They can do it based on replacement cost, or they can do it based on actual cash value. The difference between them is very simple. It's depreciation, right? So if you have replacement cost and you have a loss to your roof, that means your insurance company is going to put a brand new 2025 roof of like, kind, or quality out there. Done. If you have actual cash value, what that means is that instead of getting a new roof, your insurance company is going to depreciate the value of your roof based on how old it is and cut a check for that depreciated amount. That's a huge difference. I always use TVs as a pretty relatable example of this because we've all seen it the past 15 years. I mean, you know, a 50-inch, 450-pound TV used to cost thousands and thousands of dollars, and now it's flat screens for a couple hundred. But this is a relatable example because the rate at which TVs depreciate is not crazy different from roofs in South Florida. What some of these insurance companies will pay when they factor depreciation in is pennies on the dollar. It's a big difference, okay? Unfortunately, in the past 3 years, a lot of companies have switched to this. And you may not even know it, because a lot of companies have added a form, a 1-page, in your 112-page policy that is very fluid and basically says, if a roof is 15 years old, or if a roof is 12 years old, we're gonna value that roof based on actual cash value. So it's not necessarily front and center, right there on the front of the policy. Sometimes it's buried in there. And fortunately, the past 3 renewals that I've done, all coastal high-rise towers that had 2 coastal high-rise towers, one inland, but all the same company. Last year, they had actual cash value. This year, in addition to the decrease, the company was agreeable to take it off completely. This is a huge, huge difference. So, and this is kind of a little bit of behind the scenes, and I know this is probably unusual to see in a broad kind of class like this, but I literally put my correspondence with the underwriter into this class for today, because I think it's relevant for you guys to see how this actually happens. So we got our renewal quote from this company, and this is a February 1st renewal. This email's from January 16th, so this is last week. And when we got the renewal quote, it came as it was last year. I mean, it was a decrease, but terms were the same, okay? This is legitimately the correspondence, word for word. We got the quote, I sent an email back to the underwriter, asked them to take off the actual cash value. Literally asked for it. I provided some maintenance documentation that the association has and does frequently. Underwriter emails back and says, all good for replacement costs on the roof. Change the quote. So the reason I emphasize this is because you have to have these conversations, and I would encourage you, and by the way, I work with a lot of you in this room. I encourage you as well to push the agent. I mean, you have to, right? So you're seeing premium decreases, but what you should also be seeing, and I feel strongly about this, is improved terms. And hopefully you don't have to push your agent. Hopefully you're working with someone who's just gonna do this because it's natural to do when the market's getting better. But these are big differences, and they're becoming readily available as the market shifts. Another one of these is ordinance or law, which is code compliance. A lot of companies have stripped that. A lot of companies have taken off coverage for code compliance, meaning if you have a loss to your building or buildings, you're gonna have to rebuild up to the 2025 building code. So wiring, plumbing, impact glass, depending on how old the roof is, different things with the roof, that can get very, very expensive quickly. I mean, I've seen claims double because of the cost to increase the code. That's starting to come back. So I'd encourage everyone to ask about that at renewal. We're also starting to see co-insurance go away in a lot of cases. Co-insurance, basically a fancy insurance term for claim penalty. It means that if you have a loss, your insurance company, if you have co-insurance, can come in after you've had the loss, appraise your building or buildings, and if they feel that you underinsured, so if you're insured for 20 million and they say you should have been insured for 25, at the time of loss, they penalize the claim. Doesn't have to be a total loss. So if you have a $100,000 water damage loss, your insurance company, if you have co-insurance, can come in after you've had the water loss and say, you're underinsured, we're not gonna give you the full 100,000. We're gonna give you something less. It's one of those things that is very obnoxious and that a lot of associations find out they have after they've had a claim, unfortunately. But a lot of companies are starting to offer agreed value, which means no more co-insurance. It means they've completely waived their right to do that after you've had a claim. So push back on all these things, replacement costs on the roofs, ordinance or law, agreed value. We're starting to see the lower deductibles again. In some cases, how many of your communities' deductibles have gone up? from a 2% or a 3% to a 5% or in rare cases more. It's been everyone, right? So this is actually the same renewal, a February 1st renewal, but in addition to the replacement cost, no more ordinance, or no more agreed value, increased ordinance of law, premium decrease, we were also able to offer a 5%, which is what they have now, and a 3% deductible. So premium going down either way, which is really unique because we've seen the opposite for 3 years. We've seen premiums going up, deductibles also going up, sorry for you. So this is a lot different, and it can be very relevant depending on your community. This particular building, going from a 5% hurricane deductible for them to a 3% is a $21,000 per unit difference if they have to assess for the deductible. Each unit is going to owe $21,000 less with a 3% than they would with a 5%. So it's very relevant. So all of that being said, I'm hopeful that's a lot of kind of peel back the curtain. Here's how we got there. Here's what to expect. And then as far as positioning your communities going into this renewal, you have to kind of change the way that you think. Is my opinion. I think that going into this renewal, it's much more reasonable and it's much more realistic to push for alternative options. Now, there may or may not be a plethora of them depending on your community's unique characteristics, but this is the time to start having those conversations. I would encourage everyone to sit down with their agents early. I mean, if you guys have updated your roof, if you guys need to update your appraisal, accomplish all this stuff early so that you can be in a position to really go out and market and ensure that you're getting every single quote that's available out there, right? I know I said meet with your agent early. I don't just mean 2 weeks instead of 4 days this year to do the renewal. That's not what I mean. I mean that you should have a pretty consistent and a pretty fluid line of communication with your agent throughout the year, right? So that's budgeting. To be honest, we always do the budget meetings, but we've also been doing a lot of pre-renewal meetings because there's a lot going on. So we've been budgeting, we've been sitting down 90 or 120 days out to say, look, here's what we had outstanding last time. You guys have a roof project, how's that going? There's an open claim, how's that going? Having all those conversations ahead of time is really important in this market because, again, you have to change the way you think. It's not necessarily, hopefully we get a renewal. Now we have to try to maximize that renewal. I mean, we have to try to get out the door with the best program available, which is a refreshing conversation, right? So, and then I know this sounds silly, and this sounds like common sense, but this is the last thing. And I only emphasize this because I've seen it a lot. Particularly in this market, if you're making these improvements, if your community's replacing roofs, if you're installing impact glass, if you're doing anything that common sense wise sounds like it's going to be beneficial from an insurance perspective, make sure that you're clearly and consistently communicating that to the agent. Again, I know that sounds redundant, but there's been numerous times where we've started working with an association and they were using their 2001 roof replacement year instead of 2021 when they updated it. I mean, it's crazy. Some of that stuff can slip through the cracks. So make sure that you're communicating that, again, to make sure that you're coming away at the end of the day with a positive renewal. So I know that's a lot, and hopefully that was a little bit more positive than these courses have been the past 3-4 years. I promise, it's getting better. Insurance is cyclical. We're definitely starting to see a healthier, more competitive environment. So that's a lot to digest. I'm happy to answer any questions. I don't know how I did on time, but if we have, okay.
So you can go right ahead. Anybody have questions for Andrew? Happy
Yeah,
to take
Helen.
some.
Hi. How long does a wind mitigation report last?
Yeah. So that's a good question. Bear with me because the portion of this is going to be pretty illogical because we have to talk about citizens a little bit. So citizens specifically will sometimes require updates, Helen. The thing with the wind mitigation forms is unless something changes, you shouldn't be required to update it. I mean, that's my opinion, I guess, but here's why. Is because, say your wind mitigation report's 5 years old, right? That report gives you the wind mitigation information. So the age of the roof to wall connections. Do we have impact class? If you haven't changed any of that, then you're gonna spend, $100, $200 on a report per building that has the exact same information, just with a different date. So some companies will require you to update it. Most of them won't, I will say. So I know it's not a great, how long is it good for, because it depends, but that's kind of how the industry looks at that. Yeah.
Thank you.
Yeah. Any other questions? That's good.
I got it.
Yeah.
So you mentioned that the new carriers coming in